Hi, I'm Loretta of Loretta Makes a Million. I'm the one taking a challenge to make $1 million in profit from trading options over the next number of years. Today you're watching video number 2, Option Basics Short Calls. You should have already watched video number 1, Option Basics Long Calls. Before we get started, I want everyone to understand that this video is for educational purposes only. I am not a registered investment advisor. I am not offering investment advice. Please be aware that there is risk and potential losses associated with options trading. If you're watching this video on YouTube, then come to my website, lorettamakes-a-million.com. There you can sign up for my free newsletter to stay up to date on my trades, helpful hints exclusively on my site, and other exciting information. In this video, we will review what is an option contract, what is a call option, what does it mean to be long the call option. Then we'll discuss what does it mean to be short the call option, and we will take a look at the profit and loss chart for a short call. Let's begin. What is an option contract? An option contract is an agreement between a buyer and a seller that gives the buyer of the option the right, not the obligation, to buy or sell an underlying at an agreed upon price by a set date. What is a call option? A call option gives the buyer the right, not the obligation, to buy an underlying at an agreed upon price by a set date. The buyer of a call option is said to be long the call. The seller of a call option is said to be short the call. Buyers are long, sellers are short. Buyers of calls want the market to move up. Sellers of calls want the market to stay flat or go down. Buyers pay a debit when buying an option. Sellers receive a credit when selling an option. The seller of a call option has the obligation to sell an underlying at an agreed upon price by a set date if the option is exercised before expiration. The seller of a call benefits when the price of the underlying goes down or stays flat. For example, on September 24, 2014, Google is trading at $589. You think the price of Google will go down in the next couple of months. You sell one contract of the November 2014 $590 Google call option for a $19.20 credit that will expire in 58 days. The premium in this example is $19.20. The premium is what you buy or sell an option for. It is referred to as a debit or credit. In this case, you receive a credit of $19.20. The strike price is $590. The $590 strike is the at-the-money strike. The at-the-money strike is the strike that is closest to the current market price of the underlying. The underlying is Google stock. Remember that one option contract is equal to 100 units of the underlying. In this example, one contract is equal to 100 shares of Google. The days to expiration are 58. The expiration month is November 2014. That means that the option will expire in the month of November 2014. Question: what if the Google stock price decreases to $550 at expiration? The buyer of the call option will not exercise the option, and the option will expire worthless. The buyer has the right to buy Google from you for $590. The buyer will not buy Google for $590 if Google's current market value is $550. You, the seller, keep the $19.20 credit for a maximum profit of $1,920. Here's how the maximum profit is derived. You take the $19.20 credit that you received for selling the call times 100 shares of Google for a profit of $1,920. The maximum profit for a short call is the credit received times 100 units of the underlying. You, the seller, benefit when the price of the underlying goes down. In this example, we let the option go to expiration. The closer you get to expiration, the riskier the trade gets. A lot can happen to the stock price in the next 58 days. It can be down one day and be way up the next day. Question: what if the Google stock price decreases to $541 at 39 days to expiration? You check the market to see how much you can buy back this option for. The mark is at a $6 debit. In review, the mark gives you a sense of what the current market value of the option is. The mark is the midpoint between the bid, which is how much you can sell an option for, and the ask, which is how much you can buy an option for. You buy back the $5.90 short call for a $6 debit. You will note that to close a short call position, you have to buy it back. You make a $1,320 profit. Here's how the profit is derived. You take the $6 debit that you paid to buy back the call and subtract it from the $19.20 credit that you received to sell the call, and that would equal $13.20. $13.20 times 100 shares of Google would give you a profit of $1,320. You did not make the maximum profit of $1,920, but you were able to exit the trade early. Exiting a trade early is a safer strategy than waiting until expiration. Question: what if the Google stock price increases to $650 at expiration? The $5.90 Google call strike is $60 in the money. A call option is in the money when the option strike price is below the market price of the underlying. 590 is less than 650. At my brokerage, if you are short a call and the call strike is even 1 penny in the money at expiration, which in this example would be a Google stock price of 591 cents or greater, the option will be exercised and your account will be shorted 100 shares of Google. To cover the short shares, you either have to buy 100 shares of Google at the current market price, or if you already own 100 shares of Google, those shares will be taken out of your account to cover the short shares. Here is how the loss is derived if you don't already own 100 shares of Google. 590, the call strike price, subtracted from the 650 current market price of Google would equal $60. $60 times 100 shares of Google would equal a loss of $6,000. That $6,000 loss is then reduced by the $1,920 credit you received when you sold the call. This would give you a net loss of $4,080. You are obligated to sell 100 shares of Google for $590, even though the current market price is $650. If you already own 100 shares of Google, your loss or profit would depend on what you originally paid for the stock. For example, if you originally paid $500 a share, then selling those 100 Google shares for $590 a share would give you a profit of $10,920. Here is how the profit is derived. You subtract the $500, which is how much you originally paid for Google stock, from the 590 strike price, which would equal $90. 90 times 100 shares of Google would give you $9,000. You then add the $1,920 credit that you received when you sold the call to the $9,000 for a profit of $10,920. Question: what if the Google stock price increases to $650 at 39 days to expiration? You check the market and the mark is at a $62.20 debit. You buy back the $5.90 short call for a $62.20 debit. Here is how the loss is derived. You subtract the $19.20 credit from the $62.20 debit, which would equal $43. $43 times 100 shares would give you a loss of $4,300. You have a $4,300 loss, but now the short call position is closed. You no longer have the risk of the option being exercised or the risk of a greater loss if the stock price continues to increase. As a reminder, the buyer of the call option can exercise the option anytime before expiration. Here's something to think about. If you had bought back the short call option before Google had gone up to $650, you would have lost less money. The way I trade is I never let my positions go to expiration. In all cases, whether the value of the underlying has gone up, down, or stayed flat, you want to close your positions prior to expiration. If you trade through expiration, you are taking on an unknown amount of risk. If I have made money on a short call position, meaning that the market has moved down or is flat, I'll buy back the position for a profit. If I'm losing money on a short call position, meaning that the market has moved up, I'll buy back the position for a loss so that I may avoid a greater loss. Short calls have unlimited loss. As long as the underlying keeps going up in value, I can lose more money. Short calls have limited profit and unlimited loss. For this reason, I do not trade short calls by themselves, but it is important to understand them. Later, in my video series under the topic of credit spreads, you will learn how to remove the unlimited risk of a short call. Now, let's take a look at a short call profit and loss chart. You will notice that it is the opposite shape of a long call profit and loss chart. On November 20th, 2014, Google is trading at $534.66. You sell one contract of the January 2014 535 Google call option for a $16.90 credit that will expire in 57 days. The red line is the profit and loss graph of the short call at expiration. For now, we're going to focus on the red line and ignore the white line. Here is the zero line. Any point above the zero line is profit, and any point below the zero line is loss. This dashed red line represents the price that the stock is currently trading at. In this case, it's $534.66. Here is the strike price. Here is the break-even point. The break-even for a short call is the point the stock price needs to be less than in order for us to make money at expiration. The break-even point for a short call is determined by adding the credit received to the strike price. In this case, a credit of $16.90 is added to the 535 strike for a break-even of $551.90. We need the price of Google to be less than $551.90 to make money at expiration. We want the market to go down or stay flat. A short call has limited profit. The maximum profit one can make is the credit received times 100 units of the underlying. In this example, the max profit is $1,690. Here is how the maximum profit is derived. You take the $16.90 credit you received to sell the call times 100 shares of Google, which would equal a maximum profit of $1,690. Now let's talk about loss. Short calls have unlimited loss. As long as the price of the underlying keeps going up, you can lose more money. What if Google ends up between the strike and the break-even point? The seller of the short call will have a profit, but not a max profit. For example, if Google ends up at $540 at expiration, then you will have a profit of $1,190. The profit is derived by subtracting $540, the price of Google at expiration, from $551.90, the break-even point, which would give you $11.90. $11.90 times 100 shares of Google would give you a profit of $1,190. This graph represents the general profit and loss graph of a short call. Short calls have limited profit with unlimited risk. Now let's talk about the white line. The white line is the profit and loss graph of the short Google call today. As each day goes by and we get closer to the expiration date, the white line gets closer to the red line. This will be explained in a later video. You will note that it takes longer to make a significant profit on the white line than the red line. This means that we make more money as time goes by. For example, if Google dropped to $530 today, you would have a profit of around $200. If Google dropped to $530 at expiration, you would have a profit of $1,690. Sellers of options make more money as time goes by. Let's review what we have learned in this video. A call option gives the buyer the right to buy an underlying at an agreed-upon price by a set date. The seller of a call option has the obligation to sell the underlying at an agreed-upon price by a set date if the option is exercised. The seller of a call option is said to be short the call option. Sellers of calls want the market to stay flat or go down. Short calls have limited profit and unlimited loss. That's it for this video. Please join me for my next video, video number 3, Option Basics, Long Puts. Thanks for joining me on my $1 million journey.